Every night, while you're asleep, banks around the world pass each other trillions of dollars, not as loans, not as investments, as IOUs, temporary promises, handshakes in the dark, money that exists for hours, sometimes minutes, before it vanishes back into the system. And if this overnight exchange ever stops working, even for a day, the entire global economy could seize up like an engine without oil. Most people have never heard of it. Most people will never see it. But it's running right now, underneath everything. This is the repo market, and it's the most important financial system you've never been taught about. You probably think banks just hold money. You deposit your paycheck, they keep it safe, maybe they lend some of it out to other people. Clean, simple, boring. But that's not how modern banking works. Banks don't sit on piles of cash. They can't afford to. Cash sitting idle earns nothing, so they lend it, invest it, move it, over and over, squeezing profit from every dollar multiple times a day. The problem? Sometimes they run short. Not because they're failing, because the timing doesn't line up. They need cash now to meet regulatory requirements or settle a transaction. But their assets are tied up in bonds, loans, mortgages, things that can't be turned into cash instantly. So they borrow from other banks every single night. And the way they do it is so strange, so invisible, and so critical that when it broke in 2019, the Federal Reserve had to inject hundreds of billions of dollars into the system just to keep it breathing. Here's how it works. Imagine you're playing a strategy game. You've got resources, gold, timber, units, but you need to make a trade right now to avoid losing territory. You don't have the exact resource on hand, but you do have valuable items in your inventory. So you make a deal with another player. You give them your legendary sword as collateral, they give you the gold you need for the next round, and tomorrow you buy the sword back. They get a tiny fee. You get to stay in the game. That's a repo. In the real world, Bank A has treasury bonds worth $1 billion, but they need actual cash, say $500 million, to meet their reserve requirements tonight. Bank B has cash sitting around earning almost nothing. So Bank A sells their treasury bonds to Bank B with an agreement to buy them back tomorrow at a slightly higher price. That difference, maybe 0.05%, is Bank B's profit. A few hours later, the transaction reverses. Bank A gets their bonds back. Bank B gets their cash back plus interest. It's a loan. But it's structured as a sale and repurchase. That's why it's called a repo, short for repurchase agreement. And this happens every single night. Trillions of dollars, thousands of transactions, a hidden ocean of IOUs circulating between the biggest financial institutions on the planet. Let's talk numbers. On any given night, somewhere between $3 and $5 trillion moves through the US repo market alone. For context, that's roughly the size of Germany's entire economy, changing hands every day. Globally, the number is even larger. Some estimates put the shadow banking system, which includes repos but also other short-term lending, at over $60 trillion. That's about 2/3 of global GDP. And most of this activity is invisible. It doesn't show up on balance sheets the way a traditional loan would. It's not regulated the way deposits are. It exists in this strange financial twilight zone where banks, hedge funds, and institutional investors borrow and lend on razor-thin margins, often using the same collateral over and over. It's efficient, it's sophisticated, it's also wildly fragile. Here's the thing about IOUs. They only work if everyone believes they'll be repaid. In a repo transaction, the collateral is supposed to protect both sides. If Bank A can't buy back the bonds, Bank B just keeps them. Safe, right? Except the collateral is usually valued at market price, and if the market crashes, that collateral loses value instantly. Now Bank B is holding bonds worth less than the cash they lent. They've taken a loss. Multiply that across thousands of transactions, and suddenly you have a chain reaction. This isn't theoretical, it's happened. In 2008, the repo market was one of the first systems to collapse. Lehman Brothers couldn't roll over its repos. Counterparties refused to lend. The collateral, mortgage-backed securities, turned toxic overnight. And once the IOUs stopped circulating, the whole machine ground to a halt. The government had to step in with emergency loans, bailouts, guarantees. Because if the repo market dies, banks can't meet their daily cash needs. If banks can't meet their cash needs, they stop lending. If they stop lending, businesses can't make payroll. The entire economy freezes. Fast forward to September 2019. No financial crisis, no Lehman moment, just a normal Tuesday. And suddenly, the overnight lending rate in the repo market spiked from around 2% to over 10%. 10% for an overnight loan, backed by US Treasury bonds, literally the safest asset on Earth. That's not supposed to happen. That's like your savings account suddenly charging you 10% interest to hold your money for 24 hours. It doesn't make sense, but it did happen because there wasn't enough cash in the system. Why? A combination of things. Corporate tax payments drained reserves. Treasury auctions pulled liquidity out of the market. Banks were sitting on more reserves than they wanted to lend. And the regulatory rules put in place after 2008 made it harder for banks to quickly move money around. So the market seized, and the Federal Reserve had to intervene, again, flooding the system with overnight loans to bring rates back down. They called it a technical issue, a plumbing problem, nothing to worry about. But the plumbing is the system, and if the plumbing breaks, everything backs up. The uncomfortable reality is this. The global financial system runs on a level of trust and coordination that would make any game server admin nervous. Imagine thousands of players all trading the same rare item back and forth, each one using it as proof they have enough value to make other trades. As long as everyone keeps trading, the system works. But the moment one person holds onto the item too long or questions its value, the whole loop collapses. That's the repo market. And the really wild part, the collateral gets reused. Let's say Bank A repos a treasury bond to Bank B. Bank B can then turn around and repo that same bond to Bank C. Now the same asset is backing multiple loans. It's called rehypothecation. How many times can a single bond be reused? Estimates vary. Some say 2 or 3 times. Others suggest it could be as high as 4 or 5. That means $1 trillion in actual treasury bonds might be supporting 3 or 4 trillion in overnight lending. The leverage is invisible, the risk compounds, and no one, not regulators, not central banks, not even the participants themselves, has a complete picture of who owes what to whom at any given moment. After 2019, the Federal Reserve didn't just intervene once. They kept intervening. They created something called the Standing Repo Facility, essentially a permanent backstop. If the overnight market freezes again, banks can always borrow from the Fed. It's like putting a cheat code into the system. Infinite liquidity, just in case. The European Central Bank has similar mechanisms. The Bank of Japan, the Bank of England, all of them quietly lubricating the IOU network, making sure the gears don't grind to a halt, which sounds reassuring, until you realize what it actually means. It means the system can't function on its own anymore. It needs constant supervision, constant intervention. The invisible hand isn't invisible. It's a central bank with a fire hose, ready to spray cash into the market the moment something wobbles. And every time they step in, they reinforce a dangerous assumption, that the system is too big to fail, too interconnected to collapse, and therefore safe to keep pushing to the edge. There's this narrative in finance that modern banking is efficient, rational, optimized, that we've learned from past mistakes, that regulations and stress tests and capital buffers make the system resilient. And in some ways, that's true. Banks are better capitalized than they were in 2008. There are more safeguards, but the repo market exposes the contradiction. On paper, banks are holding more reserves, more safe assets, more liquidity. But in practice, they're still operating on the thinnest possible margins, still borrowing overnight to meet daily needs, still relying on a network of IOUs that could evaporate the moment trust breaks. Because the incentives haven't changed. Banks still make money by lending, not by holding cash. And the easiest way to maximize returns is to keep cash moving, borrowing short, lending long, using every available trick to squeeze an extra fraction of a percent. The system is designed for efficiency, not resilience. It's optimized for calm weather, not storms. Here's the thing that keeps economists awake at night. The repo market isn't just banks lending to each other. It's hedge funds, pension funds, money market funds, foreign governments, everyone who needs short-term liquidity or has cash to park overnight. And because it's so efficient, so cheap, so liquid, it's become a critical piece of infrastructure. Companies use it to manage cash flow. Governments use it to stabilize currencies. Investors use it to leverage their positions, which means when it works, it's invisible. When it breaks, everything breaks. In 2020, when COVID hit and markets panicked, the repo market spiked again. The Fed had to step in with emergency lending facilities, buying bonds, injecting liquidity. In 2023, when regional banks started failing and depositors pulled their money, the repo market tightened. Again, every crisis, the same pattern. The IOUs stop circulating. The machine freezes. The central bank intervenes. And each time, the intervention gets bigger. So what happens if there's a crisis the central bank can't solve? What if the collateral itself becomes worthless? What if inflation makes treasury bonds unattractive? What if geopolitical tensions freeze cross-border lending? What if the players in this global game of hot potato just stop playing? The repo market is built on an assumption that someone, somewhere, will always be willing to lend overnight, that the system will always have enough liquidity to keep the IOUs moving. But assumptions break, markets panic, trust evaporates. And when that happens, there's no rulebook, no automatic fix, just central bankers making judgment calls in real time, trying to keep the system alive long enough to figure out what went wrong. There's something darkly funny about all of this. We've built the most advanced financial system in human history, a network that can move trillions of dollars in microseconds, that can price risk across continents, currencies, and time zones, that can coordinate thousands of institutions in a synchronized dance of lending and borrowing. And it all depends on a bunch of overnight IOUs that most people don't even know exist. It's like discovering that your entire city's power grid runs on a single extension cord that gets unplugged and replugged every night at midnight. It works. Until it doesn't. And when it doesn't, we find out just how much we've been taking for granted. The repo market will keep running tonight. Banks will lend. Borrowers will promise to repay. Collateral will change hands. The machine will hum along, invisible and efficient. And tomorrow, it'll happen again. Because the system can't stop. It's too big, too interconnected, too essential. But essential and fragile aren't opposites. Sometimes they're the same thing. So the next time you hear about a liquidity crisis or market stress or central bank intervention, just remember, they're talking about the IOUs, the promises being made in the dark, the handshakes that keep the global economy from seizing up, and the uncomfortable truth that none of us can afford for them to stop. If you made it this far, you're probably the kind of person who wants to understand how the game actually works, not just the version they teach in economics class. This is 8-bit economics. We break down the financial systems running in the background, the ones that matter, but nobody talks about. Subscribe and turn on notifications so you don't miss the next one. And if you know someone who'd appreciate understanding what's really happening underneath the economy, someone who asks the uncomfortable questions, send this to them. The more people who understand how the machine works, the harder it is to pretend everything's fine when it's not. See you in the next video.